everyone, this is Avis CAR. We're recording a weekly session of Chartsarefun. This is for the week of April 20th, recording this in the afternoon of April 25th. Our YouTube site channel is Chartsarefun, and so is our Substack site. I appreciate you subscribing to the Substack service. It's a daily service, so with your email, you'll get the the blogs as soon as they come out. And this blog that we published this weekend was about the consumer sentiment hitting an all-time low. This has been around for the Michigan consumer sentiment since 1978, and the U.S. consumers that were interviewed are extremely low in the prospects of lower incomes moving ahead. We know that there's job cuts from Microsoft and Meta. All the spending that they're doing in AI is then resulting in job cuts for them to be able to justify that capital spending, move the money out of the employees into capital spending. So we'll talk about that's the impact of Main Street. It's hurting, but then talk about what Wall Street is doing, which is celebrating the AI hyper growth with huge move in semiconductors. That's what we're going to talk about today, but then with some early warning signs of a potential top that could be happening in the S&P 500. Our YouTube channel is Charts Are Fun. We appreciate you subscribing to that channel. And if you do like the videos, if you could hit the like button, we really appreciate that. We don't provide investment advice. Our goal is to share you fun patterns in charts that they can use towards your investment decisions. Last week, we talked about transports. We talked about the breakout in transports. We talked about potentially the driver of the transports, in particular, the Dow Jones Transportation Index, which has been around since 1884, one of the longest and the most historic index, had been driven higher because it was price weighted by Avis. So look at the Avis chart, and that's got a very interesting ticker symbol called CAR. And look at what it did. It absolutely went parabolic, climbed throughout the end of day Tuesday, and then Wednesday it opened up with a spike higher towards 850. So from the previous Friday, it closed near 450 or so. On Monday through, almost doubled from there towards 850. So from the 400 level to 850, peaked intraday early in the morning when it opened on Wednesday, and from there 3 successive days it sharply pulled back, got cut more than 75% from above 850 to a close near 200 is what it closed on Friday. Now if you look at the long-term chart, this is the weekly chart. Every week is every candle is a week here. We've seen similar patterns of that intra-week spike and closing a lot lower. That's what a bearish reversal candle looks like in the late 2021, before the 2022 bear market correction. So there we can see extremely overbought RSI, and from there how sharply RSI came down as CAR came down. In a similar way, we got that intra-week reversal during the week. On Wednesday morning, it touched 850, almost close to 850, and from there pulled back and closed near 200. And so with this extremely overbought level, this tells us what can happen to parabolic charts. And then the transportation index also had a huge climb during the last few weeks, and we can see that it reached almost 24,000. We can see 24,800. Our measured target was actually 23,800, was at least 1,000 points more than the measured target. And the measured target was based on this double bottom kind of a base pattern between 11,900 to 17,800. That's 6,000, almost 5,900 points added to 17,800. That was around 23,700 or so. It overshot that by 1,100 points, hitting 24,800. And then by the time it closed the week, it came down almost 4,800 points or 4,000 points, from 24,800 to 20,800. A reversal, very bearish looking candle. A similar kind of a reversal tail was also there in the November timeframe with CAR. So it timed exactly with CAR. So just like we had the pullback in CAR leading to the transportation average pulling back, same kind of pattern. Higher high in price, lower high in RSI. Classic topping is how toppings happen. Negative divergence, same negative divergence panned out here. Higher high in levels in Dow Jones Transportation Average, lower high in RSI, negative divergence, and that is where the reversal happens. So now the question is, the fact that transportation average had a leading reversal before the S&P correction, maybe are we setting up for something similar? If that has peaked out and the transportation keeps coming lower, maybe the S&P 500 is set for its correction. So before we go there, we want to talk about the AI euphoria. This week, in fact, for 18 days, not just this week, since the March 30th low. The SOXX, the iShares Semiconductor Index, look at just how much it has climbed. In the last 18 consecutive days, it has been up every single day. And in that 18 consecutive days, the rate of change is at 49%. So 49% upward move in the iShares Semiconductor Index in a span of 18 days. We can see how overbought RSI is over 85. And if you look at the pre-market and post-market trading quotes with the full week at 30-minute candles, we can see on Wednesday and then on Thursday, two key earnings came out. Texas Instruments, and these are old age companies from a semiconductor, but then their fabs are, their equipments, their semiconductor equipments and fabs are seeing a lot of interest. And Intel in particular absolutely wowed Wall Street, announcing a revenue of 13.6 billion for the first quarter, and then for the next quarter, upgrading their revenues from 13.8 to 14.8. So much higher than what Wall Street was expecting. However, in the ICE shares semiconductor ETF, we can see that that's the Wednesday's trade. So after Wednesday, it shot up in the post market after Wednesday from Texas Instruments. This is in the right at 4 o'clock. That's the post market. It pulled back some in the pre market. Then again, when trading started on Thursday, it continued its climb, pulled back. By that, we see this reversal candle. That was a flash crash that happened in the afternoon around 1 o'clock or so on Thursday. So that's what cautions us that you've got to be careful with what's going on. High volatility, anything can happen. And this kind of sharp pullbacks, it shows us from 446 pulled back to 434, reversed, and then came Intel's earnings. And Intel's blowout earnings helped semiconductors to get the euphoric climb. And from 434, it climbed all the way up to 463. But in the 30-minute chart, we can see a negative divergence in RSI, lower highs in RSI, to be a bit cautious into what happens into trading next week. If you look at the long-term daily chart, in this case, projecting it back to 25 years of iShares trading, and look at when else did it have such a sharp 18-day rate of change at about 49%. And we can go back all the way to the dot-com bear market into 2001 and 2002 when we had that kind of a sharp climb. Three such peaks of close to 30% and higher kind of rate of changes over 18 days. But those are coming out of a bear market, you get that. But now look at the parabolic climb from a 5-wave climb that the SOXX has had. From wave 1, 178, pulling back to 96 as wave 2, 262, wave 3, 153, wave 4, and from 153, 461, factor of like 3x climb in a span of from just April of 2025 low to where we are now a year later. So April to April, 3x move. Very unsustainable move. This kind of a sharp parabolic can have sharp pullbacks. We just saw that with the transportation, just saw that with Avis. We'd be extremely cautious into it. So with that, if you look at the S&P 500, that's the weekly chart of S&P 500. This is what they call as a megaphone or broadening top. Join the tops, that's expanding in this case. Join the lows, that's forming lower lows. So higher highs, lower lows. But as that pattern is forming, look at the negative divergence in RSI. That is an early indication of this could be a topping pattern, and we could get back a pullback, and this is broadening out. So the pullback could bring us all the way to 6,200 or lower by the time this comes and tests this megaphone bottom trend line, and could this time even break lower. So that's something for us to be cautious about. And what in particular we are looking at are some technical indicators that show that the market breadth from a technical strength is deteriorating. So while S&P, by the way, so with the big move in the semiconductor index, we saw that the SOXX on the daily basis closed up 4%. But if you look at the entire week, every 5 days of the week it climbed and closed up over 11%. And Intel and Texas Instruments climbed 20% for the week. That's the kind of astronomic rises we saw in the semiconductors. But S&P has a broad 500 shares in there, only closed up 0.55%. So muted response. And if you look at S&P's percent of stocks that are above the 20-day moving average, which indicates a bullish trend, it actually deteriorated. It fell from above 80 down to below almost near 60. So that shows market strength deteriorating. As a result, the overall S&P had a muted climb of only 0.55. And then if you look at other indicators like the net high minus low, the net stocks in the S&P that were printing new highs versus new lows, that and it averaged out, they kind of normalized out from 0 to 100, that has been printing lower highs. That again is a negative divergence. S&P climbing higher highs, as we can see here, right? S&P climbing higher highs through a broadening top pattern, but look at what the new highs and lows index is doing, printing lower highs. And the same thing with not just that, with just the total number of new highs in the S&P. In the January peak had printed 111. In the most recent one, it only came up to 51. And then that was the week before. And in this week, from somewhere opening at the high about 50, closing near 33 at the lows of the week. So that indicates that with fewer highs coming in, fewer stocks participating in this last part of the bullish move. And if you then look at VIX, which is the volatility index, what happened in 2022 could be repeating here. In 2022, it traded in an upper band. The lowest it could hit is 17. The upper band was somewhere near 38. So it's traded in that range for the entire year between 17 and 38. We're just about 4 or 5 months in the year. And so far we've done touch 35, came back, and we're holding 17. 16.87 was the low. And if you look at near term from a daily chart, this was what we call as a falling wedge pattern. It broke above it. And this indicates potentially this could climb back up towards the 30s again. And the MACD in this case is converging above to close above the zero line. That could be a bullish MACD cross, which means it could mean a VIX could break out higher. So from that 16 to 21, we're talking about 5-point level. 5 plus 21, 26 or 27 is the immediate turn. Maybe from there it tests that resistance 27, 28, and then breaks further towards the 30s is what we're expecting on VIX. Now, smart money, they say, trades the bonds, and the bonds are the early tea leaves of what could be happening in the economy broadly. So the 10-year yield, if you look at the weekly chart from long term, is presenting a very interesting pattern called a flag. So flag typically could either be upward breakout or a downward breakout. In most flag patterns, it's a trend. We can see that the 10-year yield trend from 2022 from somewhere near 16 had climbed up to 49, and then this flag came. This could mean an upward resolution. We know that the new Fed chief, Kevin Warsh, is going to be taking his oath by late May. Chair Powell is going to step down. We got to see what he does with his new regime change. He's promised regime changes in the way Fed acts, and if for some reason there is heightened fears of elevated inflation from higher oil prices and overall other inflationary shocks from the geopolitical instability, then perhaps this could break higher. So if you look at the shorter term chart of the 10-year yield, in this case a daily chart for 1 year, this shows an inverse head and shoulder. We can see the left shoulder at the 4.49 or 4.5% is the neckline. Pull back to 4.2, back to 4.49. The head at a two double bottom at 3.94 or 3.95 twice into October and into most recent early March. Back to the neckline at 4.48, 4.49, or the right shoulder here at 4.22, 4.2. If we break higher, that measure target is 5.22. So a 5% 10-year yield is not going to be good for the market. Another reason to be concerned about maybe that broadening top in S&P could play out, and we should be cautious. So in summary, transportation index was heavily driven by Avis. That was a story stock. Two big hedge funds were owning over 70% of the longs of the shares, squeezed the shorts. The shorts, the outstanding shares had kind of become over 100% of what was the little float that was available in the company. That squeezed them higher. And from just over a couple of days from 400, it touched up to 850, peaked out on Wednesday morning. From there, got cut more than 75% in just 3 days, from over 850 down to 200. As a result, the transportation index, which being price weighted had Avis had stopped stock, also pulled back. Similar kind of repeat of what happened in 2022, a bearish reversal candle. From there, transportation had a bearish correction. We got that parabolic move, a bearish reversal candle, both with negative divergences in 2022 and in 2026. And this could now mean, as the transportation pulls back from its parabolic peak, it could have perhaps be signaling a bear market coming like we saw in 2022. SOXX, the semiconductors have been AI driven, huge momentum. Two strong earnings from Texas Instruments and Intel. There is huge euphoria about agents using more CPUs, inferencing from the models. The training, of course, uses the GPUs, but now the inferencing with the training with the agents, with more and more of the inferences are now shooting up CPU usage, is why Intel's, AMD, those are the beneficiaries. And the SOXX, which is iShares, has basically gone parabolic. And on the 30-minute chart, we can see climbing higher highs to the point where now RSI is showing early signals of negative divergence. We got to see if there is finally a pullback coming. If you look at the daily chart, 18 consecutive days of climbing up over almost, in this particular case, if you look at the rate of change, 49% in the span of the 18 days since the March 30th low. When else did it happen back in the past? If you look at the SOXX 25-year chart, it happened back in the bear market from the dot-com between 2001 and 2002. In particular, 2002, when it came out of that 2002 October low, it had shot up to 49%. Similar kind of a sharp move here. So this was coming out of a bottom. This is coming at a peak, just the reverse. Call it exhaustion, call it extreme bullishness, which often unsustainable, can have sharp pullbacks. We can see the 5-wave move in SOXX, wave 1, wave 2, 3, 4, and 5. Very sharp parabolic, which could just have, as we've seen with this chart of Avis and the Dow Jones Transportation, this could also have a sharp reversal, and a pullback is what we're expecting in the semiconductors. S&P weekly chart is flagging a concern with a broadening top pattern. If this pulls back, it would go below 6,300 on the next pullback. The technical indicators of market breadth, in this case, the percent of stocks above 20-day is declining, while S&P was up 0.55%. We can see the percent of stocks above 20 from 80 fell down towards 60. That shows deterioration of number of stocks that are holding above the 20, which is considered as a bullish trend. And then look at the net highs minus new highs minus lows, printing lower highs, again, a negative divergence, and net new highs also falling from close to above 50 towards 33, again indicating fewer and fewer stocks hitting new highs. It's been more concentrated into the semiconductor stocks, but most others are kind of lagging and struggling. VIX, if it repeats what it did in 2022, means it could train the entire year of 26 in that upper band from the lows in the 17 towards the 35 to 38, like it did there, is what we're watching. And the near-term chart of VIX breaking out of this, call it falling wedge, could indicate this test between 16 to 21, breaking up a 21 towards 26, 27, and then further making another rise towards 30s is what we're expecting. 10-year yield, this flag pattern from a big climb from 1.6 to 4.9% could mean a resolution. If it, of course, comes lower, it'll be bullish for stocks. But if it climbs, if 10-year yield climbs, expect small caps to get hit hard. They're very interest rate sensitive. Expect the home builders to get hit hard. And all this euphoric AI, people are trying to raise money to drive all this, these startups and all these huge AI spending will get impacted with higher interest rates, something for us to look into. And we know that the new Fed chief, Kevin Warsh, is going to come into the Fed. His first meeting will be in June. This could be a way for his hegemony in terms of how he sees the market could be reflected in this. And finally, the 10-year daily chart has an inverse head and shoulder pattern. And if this breakout above 4.48, 4.5% comes, expect it to go to 5.22%. That good luck investing. We'll talk to you next week. Just be cautious in the market from where we are, and just realize that there could be a correction coming, a deeper correction coming in the next few weeks. Thank you.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.